Good morning, ladies and gentlemen.
Brilliant. Oh, thank you so much. And as we can see, joined today by Roger Morris, recently voted the 16th most popular person from Middlesbrough. So there we go, Rog. That's an accolade for, isn't it? Narrowly missing out on a top 15 spot to Mavis from Coronation Street there. So you've excelled yourself, Rog. Something to feel good about, isn't it? Well done. We're also delighted, and I really mean that, delighted to welcome Craig Hart to us to the meeting today. Craig is a chartered accountant, and even I'll say the best looking man on the screen at the moment. So well done, Craig. Well done, Craig. So today's webinar, part of our educational series, is all about how we can understand accounts. How do we read accounts? We're going to give you a bit of an in-depth sort of source of information in regards to self-assessments, tax year overviews. And what is it to look out for in the accounts themselves? The self-employed sector is one of the most underserved sectors when it comes to mortgage lending by the high street, and it really does require that sort of specialist eye on it. And if we could all work together, and make the most out of the information that we have, then hopefully we can come up with the best solution for your clients out there in the market. So without further ado, did you want to give yourself a little bit of an intro, Craig, rather before we crack on into it?
Yeah, sure. So thank you for the intro, guys, and the build-up. So yeah, my name is Craig Hart. I'm a chartered accountant. I'm 10 years post-qualified, 17 years experience in total. I have my own practice, so it's just myself and my wonderful wife, Heather, who is also a chartered accountant, running the practice. We have 450 clients, and specialising in like limited companies, contractors, which a huge swathe of the population is now trading as. So yeah, that's kind of my speciality. Thank you.
Thank you so much, Craig. Right, so without further ado, I will attempt to share my screen. There we go.
Yeah, we can see that, Mark.
We're all on, yeah? Brilliant. There we go. Nice one. Make sure we've got our contact detail on as well. So if there are any questions post the webinar, please feel free to contact either of us, and we're happy to sort of answer any questions that you may have. But we'll move into the presentation then. So maximising the self-employed. Okay, that's what it's all about today. Maximising this sector that's underserved by the high street lenders. So a little bit of an update on the size of the prize, if you like, really, some self-employed statistics. So we're actually slightly increased on this in recent times. We're up to 4.4 million now self-employed registered people within the UK workforce. That was as of April 2023. 71% of them full-time self-employed, and 29% part-time self-employed. I think maybe sort of fitting in with that flexible, sort of lifestyle that you might need, life events, having children, a million things that might require sort of some part-time work. And a self-employed, is a really good way to go for that. The figure of 4.4 million I've given you is down slightly from a pre-COVID December 19 figure of 5.1. So that has had an effect on the self-employed market. We would assume it tied in with that. We've got a slight decline in recent years. However, we are looking at roughly sort of 14% of the UK workforce being made up of the self-employed. So it's a really, really big sector to focus on. You can see the makeup of the self-employed industry is predominantly tertiary, so service sector there, with 30% being in sort of secondary manufacturing style. So yeah, a huge part of the marketplace, and like we've said before, one that maybe some of the high street lenders might not cater for as much as the specialist sector out here. So today we're all about education, and how we can help you with those self-employed clients. Okay, so what we're going to do is we're going to run through the various sort of, I suppose, stages of the self-employed journey, because it does sort of work out like that sometimes. You start maybe as a sole trader, move through to partnerships, limited companies, and even limited liability partnerships, which maybe is not maybe as front as the rest of them, some sort of solicitor firms, accountancies, maybe in that limited liability part. But we're going to focus on the first three. They're sole traders, partnerships, and limited companies throughout the presentation. Look at the sort of documentation that you might be able to need to sort of provide to a lender. And the sort of requests that a lender will have. Once more, as Roger said, if you do have any questions, please feel free to pop them in the chat box, text into Roger if you're lucky enough to have his mobile number, and we can answer them throughout the presentation.
Mark, there's been a couple of quick questions early on, like Jazz, good morning, and Sarah have both asked, is it being recorded? So the answer is yes, it's been recorded, and it'll be available to watch and download on Tandem TV, which is found on the Tandem for Intermediary website. And that recording will cover off the slides and everything else. But any questions in the chat facility? Thanks, Mark.
No problem. Thank you, Roger. Okay, so moving forward, the first type of business we've got here is probably the most simplest type of, self-employment, the sole trader. There's no legal requirements as such. You set up and trade. You have your tax paid on the profits that you make, and you have full liability for all the debts. You do not need to prepare accounts themselves, but you do have the requirement to confirm your income and expenditure figures to the HMRC. Normally done by the self-assessment process, whether the individual do it themselves or maybe ask an accountant to do it for them, using their own software potentially, which I'm sure you'd have seen with your various clients out there with different sort of looking SA302 documents, different looking tax assessment documents, maybe down to the software that the accountant might have used. But it's very good. Sole trader, very simplistic, straightforward, and probably the first step, I would guess, in that self-employed ladder. Okay. So we move on to a partnership, which is the sort of the second form we like to say. So you have two or more individuals running a business in this instance. Partners will again be liable for all the debts of the partnership and the acts and commissions of the other partners as well, even if they've not agreed to them. So that's what a partnership is. It's a joint venture, with each responsible for the other. We'd always recommend that a partnership agreement should be written up between the two partners. But like a sole trader, tax is paid on profits, and there's again no legal requirements as such for the entity. It's just set up and trade. Have you got any comments you want to make around either of those subjects, Craig or Rog, that I've just mentioned so far, or have I covered things that you would?
Yeah, so there's a bit of a time consequence, so you do have to inform HMRC that you are starting to trade. Simple forms online for both self-assessment, self-employed and partnership. You are technically supposed to do that within 3 months, although I find that in practice there is no penalty as long as you meet the deadline for filing your tax return by the 31st of January if you file online, the following year to which you start trading. So just to mention that.
Brilliant. No, that's really useful information. Cool. So moving on to limited companies then, the sort of type of business. So it's a pretty much a transitional step really from sole trader to partnership through to limited company. It is a much more it is a greater step. It becomes a lot more formal. Must be registered at Companies House. The company must have at least one company director. We need to have various sort of legal documents associated with the entity, including a memorandum and articles of association, and you must prepare annual accounts that report on the performance and activities throughout the year. The accounts need to include a balance sheet and a profit and loss account, which then needs to be submitted through to Companies House. And later on in the presentation, we're going to be having a huge focus on the accounts themselves, how to read them and what we look for. But are there any points you'd like to add on that slide, Craig, in regards to this sort of limited company setup?
Can I just, I've got a question for Craig related to this one. This is your question, Craig. Why do some accountants advise that some limited company directors to take PAYE salary and get pay slips as opposed to or as well as director's salary, as they have a majority shareholding? That was the question, Craig.
Yeah.
Attends to the thing, Chris. Is there a tax benefit for this?
Sure. So in most cases, you will set up a PAYE scheme and pay yourself a salary from your company. So assuming you've got just an individual who's contracting, they own 100% of the shares in the company, then the most tax efficient way of drawing money out from the company is by drawing a basic salary, so normally £12,570, which is the personal tax-free allowance. You would pay that as a salary every year, and then anything above that you would pay as dividends. Now, what I've seen in a couple of cases is where an accountant or a mortgage advisor kind of comes up with a bit of a grand plan to increase your earnings, and then basically pay a larger salary. So you might say, well, I'm going to pay myself a salary of £5,000 a month for 3 months to make, boost my earnings up. And you're right in what you're saying that most lenders do not take a salary as a form of income where the individual is a 100% shareholder or a majority shareholder, in fact. So it works against you. So there's no tax benefit of paying a higher salary. So the maximum salary where there's a tax benefit generally is 12,500. There are some exceptions to that this year where you've got some employees and you can claim the employment allowance. You can potentially pay a bonus if you've got profits over 50 grand, and then that is more tax efficient. But that's on a case by case basis. And so, yeah, so it can sometimes work against you. I would never recommend paying a higher salary where you're the majority shareholder in an effort to try and increase or be able to use those as for borrowing purposes.
Perfect. Thank you for that, Craig. Is there another question, Roger, or should I move on?
No, carry on.
Yeah, carry on.
The ones in as we move forward, Mark. Thank you.
Perfect. Thank you, Craig. All right, then. So moving into the self-assessment side of things. And really, I guess, looking at the documentation that a lender will require when dealing with a self-employed client. So we're maybe familiar with some of these terms: tax calculations, SA 302s, tax year overviews. We're going to give you some information around what these documents look like, the sort of information they contain, and what a lender is looking for within them, and also actually how to to request them if your clients are unsure and you're trying to guide them through the the mortgage process, because these are documents that you will need for lenders. So right, moving on.
Mark, just one question relating to that. Sorry, Mark, but there's so many questions coming in. I'm trying to pick it. Good morning, Robert. I'm not sure if it's Robert Wolf, my friend from Manchester. Robert's question is this: there's something we might not have covered, but Robert's question is: explain, please, why do some accountants, Craig, say SA 302s are not produced and others do? Does that question make sense?
Yeah, sure. So an SA 302 is HMRC's basically acronym for self-assessment tax calculation.
Yeah.
And so you would only have a self-assessment tax calculation if you submit a self-assessment tax return. And you would only do that if you meet the criteria for self-assessment. So if you work that back, it would only be where you have dividends more than the dividend allowance. So currently that's £1,000 this year. If you have more dividends than that, then you meet the criteria for self-assessment. Or if you're an employee and you have a salary of over 150,000, or have a salary of more than 50,000 and claim child benefit, then you fall into self-assessment. You have to file a tax return. You're probably going to have some child benefit, high income child benefit tax to pay. That's definitely something to be aware of. Anyone earning above 50,000 with children. Now, so what you can sometimes have is a limited company. Maybe it's just starting out, doesn't have a lot of profit to generate. They might pay a basic salary of 12,500 to an individual, but there might not be any dividends to pay out. So therefore, there wouldn't be a tax return, and therefore no SA 302. For any self-employed individual, there would always be SA 302s. I'm obviously not aware of what the exact circumstances are where they wouldn't, where the account would be saying they wouldn't be able to produce, but that's my experience.
No, that's great, Craig. And the other question that Pierre asked is, Craig, can you please cover why interest will be payable as shown on tax overview SA 302, plus why a penalty is due and in which situation?
Sure. So interest will be payable if the taxpayer has not settled their tax liability on time. So basically interest is accrued daily. Where you owe less than £1,000 in tax, in income tax, personally, then the tax is due on the 31st of January. Where you owe more than £1,000, HMRC asks you to pay what's called a payment on account, which is basically a payment towards next year's tax bill. So if you think the tax year ends on the 5th of April, so take 2023 for instance, you have 9 months to prepare and file your tax return and settle any tax due. But you're already 9 months into the following year. So what HMRC say is you've probably, you've had 9 months more income. We're going to base your income at the same as last year. So basically, when you do your tax return for the first year and you have a liability of more than £1,000, you basically pay a year and a half's tax in one go. And then you would pay half in July, half in January ongoing. And so sometimes people forget about the July payment on account. The interest would accrue on that. So generally that would be a relatively small amount. And then late payment penalties is where you don't settle the tax liability within 30 or 60 days of it being due. So then HMRC then start to charge like a 5% penalty, and then it kind of can go up from there. You can also have penalties for late filing of your tax return as well. So if you don't file your tax return until, say, the 1st of February, then you would have a £100 penalty. HMRC had relaxed the rules in the last couple of years due to COVID, so you had an extra like 30 days and stuff. But that's not expected to continue. 31st of January is the deadline, and those are the instances. So late filing and late payment can both hit you and then really start to add up as well. So yeah.
And Craig, what's the correct title of the document? Is it an SA 302 or a tax computation, is what Will has just asked? Or are they both the same?
So those terms are interchangeable, really. They're both the same. So a tax computation would be, exactly as we're going to show you on the upcoming screens. And that is, that HMRC just termed the document SA 302. So that's what mortgage lenders would generally use.
Thank you. Mark?
Perfect. Thank you so much. Right. So what we thought we'd do with this first slide here is, over my sort of years of being a BDM out there, brokers send me a variety of documents saying, here's this, Mark, how much will you lend? That kind of sort of situation. So, and I quite frequently get an SA 100 sort of sent through. As we're sort of aware, we're looking for SA 302s, tax year overviews, tax assessments, tax computations, but not always this SA 100 document. I'm surprised by the amount of times I get this sent through to me, really, because it's not something that we would necessarily use to sort of verify the income figures in any way. So, when you are sort of handling documents from clients, please take note of what you've actually got. Bottom left-hand corner here, SA 100. Now, this is sort of like the pre-document, I think I'm right in saying, Craig, the pre-document to the SA 302. So this is the information that your client would fill out, detailing what has happened within the period, the tax period, and it's, I guess, the pre-information before you see like the final figures, if you like. I used to get a lot of them when I worked for a lender that did a lot of buy to let, with sort of like no minimum income being a requirement for lending purposes. They'd like to see an income, but not necessarily any. There was no minimum level as such. And I think it's really important, because sometimes you can use documents for your benefit in trying to, when you getting an application through, just by knowing that these documents exist and what they contain. Because if you've got like an SA 302, for example, tax return that says your client earns £2,000 a year, well, that doesn't really show a huge amount of income for a lender to rely on as such. So it shows a small income stream coming through. Now, what I've been able to do, and it will work lender to lender, so you've always got to sort of stay close to lender BDMs, the lender's criteria themselves. But quite frequently, where I've had a situation where the SA 302 should have really, really low income figure, using this SA 100 document, you can see that the amount of sort of turnover, if you like, that's being flushed through the system. And someone who earns £2,000 could have had a multiple massive buy to let portfolio in the past, but obviously with things being upset and what have you, and the income figure that comes out the other end might be quite low. So this SA100 document is not something that a lender would normally use to verify the income, but it can be a useful document for things like that. I'm sure there are other reasons why you could use it if you sort of look through the documents in full. This is just the first 2 pages. It's probably about a 10-15 page document, I think. But I wanted to point out, because it is a document that I get sent to me, quite a bit over the years, and it's not really what a lender's looking for unless there's something that you're particularly trying to show. Okay, so that's the SA100. So we're moving on to sort of the documents that we do want to see and the things that we're looking for here. So on the screen at the moment, we have on the left-hand side the computation, the tax assessment document, and we have on the right hand side the tax year overview. Okay, so on the left hand side of the screen here, we can see this individual tax return. We can see that we've got that sort of threshold that Craig was talking about there, which will frequently be used. It's also 12,570 at the moment is the initial allowance. And we've then got some dividends that have been taken, and we've got a total income received figure of 50,070. Now, we then move down to talk about the amount of which the tax will be paid on if you take the personal allowance off. But that figure of 50,070, that is the figure that the lender will be looking for, by and large, to make their affordability assessment on. Okay, so it's that total income received figure that we'll be looking for. So when you are inputting figures into lenders' affordability calculators, that is the gross figure that you will be using for income received. Lenders out there that ask for net income, you have to make sure you take the tax off when you input it into their systems. So there are some lenders out there, including ourselves, but it's not about today. But there are some lenders who ask for a net income to be keyed onto the system. It is rare, but if you are in that position, you just need to be mindful of the fact that in this particular instance here, we consider there's $3,000 of income tax that was due. To remove that and then sort of put a net figure in. So that gross figure that most lenders will use is that 50,070. Have I missed anything there, Craig, that you'd sort of like to point out, or have I made that been quite thorough?
Yeah, no, that's a really good coverage. I would just like to say that on the tax calculation here, where you've got, in this example, pay for more employment, dividends from UK companies, this is a typical example of someone who has a limited company and they've limited their dividends to the basic rate allowance. So maximising that basic rate allowance in terms of what they're looking to draw, but not drawing out anything that's going to incur higher rate tax. So that 50,000 is the ideal amount. You would also see here, profit from any property income. So that would be net profit after any expenses, but before mortgage interest. That's shown separately now. So you might see other forms of income in there, so interest, so savings from bank savings. So there might be multiple different forms of income, but they should all be showing on here. If the property has had a lot of renovations and it's not been rented out fully in the first year, it might have had a property loss. You wouldn't see the property loss here. You would just you wouldn't see anything at all. So just to clarify that.
No, that's perfect, Craig. Thank you. This is a relatively sort of simple, I guess, example that we've used here because we want to make it straightforward to the audience. And I don't want to complicate things too much, but you mentioned sort of contractors that you deal with quite a lot at the start of the webinar, Craig. I saw a tax assessment document yesterday, actually, where a CIS worker was using this, and I have to say it looked a little bit odd, and I couldn't quite work out where it was going. So it had, as the format that we see in front of us at the moment, but it mentioned that they'd had sort of $8,000 of CIS tax due, and then $8,000 paid, and they were overpaid by $4,000 for the next year. Is that something that you see quite often with those contractor?
Yeah, certainly. So the way the CIS system works, I think so. HMRC really targeted the construction industry scheme as an area that there was a lot of underpaid tax in the country. So what they did was they introduced CIS. So all construction workers, if they are completing construction work, so for instance, new build property, commercial renovation, then so it doesn't really cover like maintenance. So if you have a builder just come over and does some maintenance, or a plumber in your property, there's no tax consequences there. But if it's a commercial, they're working for a commercial organisation, HMRC brought in a rule where the main contractor, so the person who is commissioning the works, has to deduct 20% of the invoice in CIS tax, and that would be 20% of any labour and not any materials. So what you'll find is a lot of the time you'll have a lot of labour only contractors, so they don't provide any materials. They'll just go to a site to work all year, and they'll have 20% deducted. So if they earn £1,000 in a week, they will have £200 deducted in CIS. That is taken by the bigger company, and it's paid over to HMRC, and that's done on a system called the CIS system. It's based on his UTR number, and then at the end of the year, when you put your tax return in, you would say, well, I've worked 40 weeks of the year, £200 of CIS deducted each week, so therefore it gives you a chunky amount of CIS suffered. And so when you put in your expenses, so you're deducting off your travel expenses, you might have bought a van, you've got a business phone, whatever other expenses that you're putting through for the business, you then end up in a position after the tax is being calculated where you often get a refund. So CIS guys or girls have basically generally paid more tax on file with HMRC on deposit than they have due at the end of the year. Now that starts to switch back the other way. So you have tax due, but you also have national insurance. So for a self-employed individual, that this tax calculation doesn't show on the screen, but you have 20% tax and then 9% national insurance all the way up to the 50 grand threshold. You can often get to a place where the around that 50k mark, where the CIS on file does not cover the whole tax and national insurance that's due. So you get to a tipping point where the CIS contractor is then going to start owing HMRC as you enter those higher rate tax bracket. So yeah.
Oh, that's perfect, Craig. Thank you. Because it's always one of those things. Look a bit of a day of reckoning, I guess, isn't it? At the end where they sort of, So no, perfect. Okay, right. So tax year overview on the right hand side of the screen. So these documents have sort of came to fruition. Raj, how many years ago was it we started seeing tax year overviews?
I think it was about 4 years ago. I think, Craig, it was predominantly the way it was always explained to me was it was basically a fraud detection system to alert lenders and the revenue, where you'd put in your tax calculation for income purposes for a mortgage. And then it was a way of notifying. There's very little information on, but if you go back in, say, 2 weeks later and lower your income, it can then, create a few alerts to say that there's something potentially untoward going on. That was the way it was always explained to me, Craig. Would you say roughly that's right?
Yeah, so it's just a check and balance that the tax calculation that you've got on the left-hand side of the screen has actually been filed and submitted with HMRC. So what you want to see, and what the lenders will always check, is that the income tax at the bottom, £3,106.25, matches the £3,106.25 on the tax year overview, which is on the right-hand side of the screen. So once you submit your tax return, it takes maybe a day or two for HMRC to process it. And then if they've got no amendments, so if all the information matches what HMRC have on file, then the same figure will be shown in the tax box there. And that just means that it's been submitted, and therefore it's a kosher document. It's not something that's been fraudulently or otherwise produced.
No, that's perfect, Craig. Sorry, Raj.
Sorry, Matt. Natalie G's question was just on coding, like the tax return. This is a question, Craig. Like the tax return, the tax computation has an S code. Does the tax overview have the same code or a code?
The only thing that I can think of that would relate to would be if it's a Scottish taxpayer.
Yes. Yeah. Yes, that would
So
make sense.
I've got a
That's
couple of
been
those.
sense.
So there's no like tax. You wouldn't be able to see that on the tax year overview, and you also would only really see it on here because there's slightly different tax rates applied. So yeah, that was one.
And there was just another question. Sorry, Mark. Guys, I'll be coming back to the limited company questions once we get at that section. But Lauren said, what reason would there be for a discrepancy between the tax due on an SA 302 and the tax year overview? Is that always a red flag, or could there be a reasonable explanation? So if there was a discrepancy, Craig, between the left-hand figure and the right-hand figure, would that be a red flag?
Yeah, so there's a couple of different reasons why that might be the case. The first is because the tax return hasn't yet been submitted. And if that's the case, and the taxpayer owes more than £1,000, the tax figure that you would see on the right-hand side on the tax year overview would be the tax that's estimated from the previous year. So your payments on account would be showing in the tax box until you submit your tax return for the 2023 year. So maybe if you've submitted it but not yet waited till HMRC's processed it, that can cause an issue. So you have to wait a day or two while HMRC process it. There are a couple of other reasons. One is if HMRC's information on file differs to what we've submitted on the tax return, and that will generally be because they've got student loan repayments that haven't been submitted on the tax return. So when you're self-employed, your student loan repayments are all calculated and paid over using your tax return. So if the taxpayer said, oh no, I don't have a student loan, but then actually they do, then HMRC will correct that. Another reason is if we have submitted employment income with incorrect figures. There's a discrepancy over how much employment income that they've received. So maybe they've had a little job, weekend job maybe for like a couple of weeks of the year, and they've completely forgotten to provide the pay slips. Then HMRC have already got that information on their system, so they will amend the tax calculation. So what happens in that instance is HMRC will take a good few weeks to do this, like they take with a lot of things. There's not a lot of things that happen really quickly, other than chasing you for money. But basically, the tax calculation that you see on the left-hand side, the SA 302, will be reissued, and that generally happens by post. So the taxpayer will receive an amended copy, and the accountant will receive an amended copy, and that will detail what changes have been made, and then the full final calculation. So you would always get an amended SA 302, but it takes time, so you need to get your tax return right anyway. But if you're going for a mortgage, that can really slow you down.
So that maybe answers your question, Rob Wolf. Is what Robert said is occasionally we are seeing tax year overviews not tallying with the SA 302. So I think you've kind of answered that one, Craig.
Yeah.
And another one, which was from Brian B. For self-employed people, is it a problem if in 1 year or one tax year they claim for less expenses, so there's a taxable income is higher than the following claim for all expenses? Does that make sense?
Yeah, so I think what you're alluding to there is if you've got an instance where you generally would claim, travel expenses, phone bill, whatever other costs you've got, equipment, and then if you're going for a mortgage 1 year, you just decide not to claim those expenses. Well, firstly, you're going to be overpaying in tax if you try and do that, because if you've got legitimate expenses, you should be putting them in. But also, I wouldn't recommend it, because what you're going to end up with there is potentially a mortgage that's based on figures that are not accurate, and therefore you're going to end up with debt that you maybe can't afford to repay. So yes, it's a problem for that reason, but also you really want your tax return to be accurate. You want your figures to be, the income has to be what you've received, and then your expenses are what you've paid out for the business purposes. So I wouldn't recommend manipulating any figures in that regard.
Wise words, Craig. Back to you, Mark.
Perfect. Thank you so much. So that's a little summary there around the SA302 and the self-assessment process. And yeah, it's these two numbers, 310625, that need to match with the overview. Okay, so if your clients are ever unsure about how they can obtain their self-assessment tax calculations, tax year overviews, we don't expect you to memorize this by any means. The recording will be available afterwards for you to refer to. But we've drawn a little process flow diagram for you that your clients can follow in order to obtain those documents. Of course, if the accountant does their the assessments for them, then they'll use their own software and they won't follow this process. But if the client themselves is doing it and logging online, this is the process flow that they can follow. So like I said, we don't expect you can take a screenshot of it if you want whilst we're talking. It will be available on our Tandem TV channel going forward. But yeah, we just want to give you a bit of an idea as to how your client can obtain them if they were struggling. That might well be useful for you. Okay, so moving on to other income evidencing documents that lenders will have in addition to the tax calculations. So some lenders might well require an accountant's certificate to verify income levels. At Tandem we do, and we just got an example blank document from our own website, which we use. And you can sort of see that, the sorts of questions that we will ask the accountant to complete, the sorts of things that we look to see. And lenders will have these. Some will allow you to obtain the information and send it in as part of the packaging for the case. Others will request it from the the accountant directly. So I think it's important that you speak with the lender that you're dealing with, try and work out what they want you to do as part of the packaging to make a smooth process. And if it is a case where you need to obtain a document yourself, just make sure you know where to find it on their website, etc. Get them to email it through to you. And get it completed. Once you've got it, I think as well, basically maybe read through it before you send it on as well, because we do sometimes get sort of accountant certificates that you think, crikey, like what is that? Or like the question's not being answered properly. But just make sure that you understand the information that has been written on there, and are happy to submit it to the to the lender themselves. Yeah, Craig, is there any sort of tips that you've got for accountants' references, things that sort of come up as a problem maybe, or questions that you get asked on a frequent basis that you think, right, Craig, I can't really answer that, or anything in around accountant certificates that is pertinent?
Yeah, sure. So I think one thing I would just check is that the accountant certificate matches with what the customer, the client, has told you. So often clients don't really know the terminology. They don't really know, how lenders view their earnings. They might just see, I earn £1,000 a week, so that's my earnings. I'll tell the mortgage advisor. Mortgage advisor, looks at lenders that'll borrow on that affordability, and then when it comes to actually completing the accountant certificate, they've the expenses have been deducted, or it might be salary and dividends. There might be a different year end if it's a company, which we'll come to. So, does the information that the client gave you at the first instance actually match with the account certificate? So just checking it over. The other thing that I find is that accountants are very risk averse. So what a lender will want you to do as an accountant is try and get you to commit to say that this person can afford the mortgage. There's absolutely, no doubt that there's going to be, they're going to repay the mortgage in full. There's going to be no defaults. And obviously as an accountant, at any particular point in time, you definitely, you're not going to guarantee that. So an accountant will use language that is risk averse in terms of when it comes to see the top right box on the right hand side page on the screen. It's whether there's any significant increase or decrease in profit drawings, dividends or salary, any exceptional transactions. So, an accountant will try and flag things that a lender might view as being a problem. So a mortgage advisor needs to be aware that the accountant is trying to cover themselves and make sure that there's nothing on there that's going to, you've just got to address. So make sure that, I had one recently where the client had been out of work for maybe like 5 months out of the year, so his income did drop, and the mortgage advisor wasn't aware basically when that he was out of work for a period of time. When I did the year-end accounts and did the accounting certificate, I did put a note on there to say, there was a drop in income for a 5-month period, but the business is now trading stable and reliably, and we had another 10 months worth of trading, and there's only 2 months left before the end of the financial year. So I was able, I'm confident enough to say that the business would achieve what it did in the year before that, before the business was impacted by COVID. And so that ended up, the wording was agreed with the mortgage advisor, and it was something that I was really comfortable in providing. And the guy ended up getting his mortgage no problem. So even though there was a drop in income in the last year's financial records, we still managed to be able to secure him a mortgage. He went to underwriters who did go through some more checks, but that was successful. So yeah.
No, that's perfect, Craig. A really, really great answer there. And it just shows that sort of all working together can actually get the cases, to complete, just seeing the whole picture. And it all stems from you understanding the information that you are seeing sort of in front of you. There are lenders out there, and again, it's not specific to Tandem anyway, but lenders out there that will use latest year's figures, when they assess affordability. And I think, having an accountant, like Craig here, he's clearly on board with trying to, explain why figures look the way that they do, is really important. I think if you have got like a big jump in profit, for example, and you're using, specifically going for a lender that wants to use the latest year's figures, I think like the business bank statements as well can be really, really important. The last 3 months maybe is typically what a lender might ask for. And when you have got a lender that's looking to base, the income on the most recent year, where there's been a jump maybe in profit, information that you can get from that client's accountant, in addition to bank statements which show a good flow of income running through the business, that's really what sort of lenders are looking for. So some good points there. On this screen, bottom right hand corner, you might see the accountant's stamp. Okay, so if you have got a case for a client and self-employed, that ultimately you're going to be reliant upon accounts or an accountant's reference. It is very much worth checking your accountant's or the client's accountant's qualification, and draw a comparison with the lenders that you're looking to submit it to, because it'd be very, very difficult for you to move forward with a case, particularly if it's something like the latest year's figures one, and the accountant the client uses doesn't maybe have the the qualification that is required. And that is actually a list of our acceptable accountancy qualifications. So chartered accountants, you're on there, Craig. You're okay for us? Good man.
Yeah.
So yeah, but most lenders will have a list, of acceptable qualifications to them. Like I say, if you know you're going to be reliant upon the accounts or a reference, then it is imperative that you choose a lender that sort of can work with that client's accountant. Okay. Any further questions at this point, Rog, or are we on it? You still there? All right. Okay, I will move on through. Right then. So let's just look at this slide here. So what will lenders accept? What income will they accept? So sole trader and partnership, we're looking for share of net profits. Limited companies, we're after share of the dividends and the director's salary, if you like. And generally speaking, most lenders will take 100% of each of those types of income. At Tandem, again, this isn't a plug for time anyway, but some lenders will look at things where you can maybe take a salary and a share of the retained profit rather than dividends drawn down. So lenders will have their own take on it. Most will be driven by salary and dividends that have been taken from a sort of a limited company account, whereas we're looking for sort of the share of the net profits on the the sole trade and the partnership side of things. Projections are that's more likely to be seen in an accountant's certificate, as we've just seen there from Craig, and a projection can be a really, really powerful thing. So speaking to an accountant about what is expected, what the projection might be for the next year, again, can be a real reason for a lender to take on a case that otherwise they might have, if it's a bit borderline, they might have been a bit reluctant to do so. So if you can get a strong projection from the accountant and figure, again, with those latest year's figures cases, that's really, really helpful. Or an example like Craig has mentioned there, where there might be a drop in income previously, just so we can see that we expect this sort of new level of income to continue. Okay, perfect. Right then, so if we move on to the next screen, so this is the real nitty gritty now. So guidance when reading the accounts themselves. So what we've actually got is we've got a set of sort of example accounts that we're going to run through here for you. Genuinely feel free to ask any questions that you've got, and I'm sure there'll be lots on this topic here. So I just skip to the accounts themselves. Sorry, I've scrolled down a little bit there. So Craig, would you like to take us through this set of company accounts that we have? Oh, you're on mute, Craig.
Thank you. I just don't like to have background noise going on when somebody else is speaking. Okay, so we've got a limited company here. So this is not a self-employed individual. Well, not a self-assessment self-employed individual. This might be someone who's self-employed but operating and trading through a limited company. So this is the full document, full set of accounts that is required to be produced. They are not filed online with Companies House. You have something called an abbreviated set or filleted set, which is basically a cover page and just the balance sheet. So I'll select those items from here and show you which ones are actually publicly filed and available on Companies House website. But this is the full set. So this is what a lender will ask for when they're wanting to potentially use the accounts to lend against. So the first page here is just a cover page. It tells you the company number and what's included, what the period end is. So 30th of June 2023. That is normally year ended, unless it says period ended. So then it would be either a shortened or lengthened period of time. So yeah, year ended 30th of June, and obviously the client name at the top.
Perfect. I'll click on through for you. Yeah.
Yes, please.
Just tell me when, Craig, as well. Just tell me when you want me to move on, okay?
I will do. Okay. So very simply, a contents page, which just tells you how many pages are involved. So very simple. Next page, Mark. This is company information, so it tells you who the directors are. If there's a company secretary, which is a role that is not so important now in company law, then they would be listed there. If there's multiple directors, they would all be listed. It tells you the registered office, tells you the accountant's address, a registered number and stuff. And then, so if you can go to the next page. This is a director's report, so this is actually being phased out, but it does tell you basically that the accounts are prepared in accordance with the provisions applicable to the Companies Act, which are relevant parts, whether it's in micro set, a small set, a medium or large company. And you might have some other bits and pieces in here, so it would tell you the principal activity, so what the company actually does. So you would want to make sure that that matches up with what the client's told you, what the mortgage application says. So if you can go to the next page, please, Mark. And we have a summary profit and loss account here. So this tells you the current year's income, so what the turnover is. This particular set of accounts has other income, which is generally grant income. So if you've employed an apprentice or have received kind of COVID grants or anything like that, then that would be disclosed as other income. Cost of raw materials and consumables is basically direct costs, so your materials in providing the service. So for this instance, I've gone for an electrical contractor. That's kind of my typical client, and then they've bought some materials there that needs to be recharged. We've then got staff costs, so that would include salaries for John Smith, if that's the director's name. So £12,500 you would see there. He might employ his wife or partner in an administrative capacity, or he might employ they might have subcontractors that work for him as well, so that would also be included within staff costs. You've then got depreciation, which is where you've bought an asset. So it might be, say, a van, for instance. You buy it for £10,000. You have to set a depreciation policy, so that goes on your balance sheet as an asset, and then you have to depreciate that every year. So you set a policy right at the start to say, we're going to depreciate that asset by 20% every year, and then that hits the profit and loss account as a depreciation charge, but that is actually pulled out for corporation tax purposes. The tax rules are different. You've then got other charges, so that's quite a big charge here, 22,000. So that would be things like your administrative costs, so potentially advertising, office costs, phone bills, utilities, for any offices that you run. You can't use, you can only charge an allowance of £312 a year for using your own home as an office. But there can be, all of the other business related costs can be included in that other charges. And we have a more detailed profit and loss account on the last pages, which we'll come to. You then have profit before tax for the financial period. Now, that's also known as net profit before tax. So the 121,000 might well be asked for on an accounting certificate as the income generated to the company. But then you have a big corporation tax charge associated with that. So that's generally going to be 19% of the profit. There are some adjustments that will be related to, which I won't cover, but they have just increased the corporation tax rates for profits above £50,000 from 1st of April 2023. So you can end up with a 26.5% tax charge. And what you'll generally see is people start to put a little bit more money into a pension scheme from the company, which is classed as an expense, to then reduce the corporation tax. So yeah. Let Mark switch back. There we go. So if you can just actually go, there's one more point on that other screen, Mark. It's all right. So you've then got profit for the financial period there. That is what you would term retained profit or profit after tax. And that's the amount that's available, that's been generated in the year, that is available to be paid out as a dividend. So that is the maximum amount, plus any reserves that have been brought forward from previous years, if there are any, that you can actually declare as a dividend. If there's no reserves brought forward from a previous year, you couldn't declare a dividend of £100,000 because the dividend would then be illegal. It's not permitted to, and it's not an actual dividend if you pay out more in profit than you have as a dividend. So that's quite a key thing. I've seen a couple of poorly produced accounts in one instance where there'd been dividends put down on the personal tax return of say 40,000, and there'd only been say £30,000 worth of retained profit in the year, so it took the reserves to a negative. So that's definitely a red flag to watch out for, because what would happen is, Mark, if you can just switch to the next screen, you would end up with a negative amount on the balance sheet. So a key thing to check, so the capital and reserves figure at the bottom of 2023, the £1,299, that has to be a positive figure if you've got dividends, because if it isn't, the dividends are illegal, and you're going to have a problem further down the line. I would be saying as a mortgage broker, I'm not going to. You want to kick that back to the employee, to the client and the accountant, rather than going through the process of going through an application and then finding, it's a waste of time. Okay, so this is the major, one of the major pages, not overly relevant for when you're looking at accounting certificate or affordability, but it's one of the major documents that's actually filed publicly online. So you've got a balance sheet here, and a balance sheet has your assets and your liabilities on there. So you've got a couple of different types. I'll run through these quickly because they're not as relevant, but basically fixed assets, which would be a van, equipment, something that you've bought that's a capital in nature, so it's worth more than, say, £1,000, for instance, and that's going to last for a number of years. That is going to be the net amount after depreciation. So after the depreciation has been charged to the profit and loss account, that's what the asset is worth in the books. It might be worth a lot less, it might be worth a lot more, but that's just the depreciation charge and policy that you set at the beginning that you thought what it's going to be worth in future. Let's have a look. And then you've got, that's all right, it's good to zoom in. So you've got, your fixed assets there, 11505. If you could just scroll up one touch so we can see the years. So I'll explain the columns. Perfect, thank you. So we've got 2023 there. So what that's saying is the balance sheet date is the 30th of June 2023. You can see that in the top left corner. And the 2023 figures and then the comparative year for 30th of June 2022 are next to each other. So you can kind of see how the balance sheet's moved year on year. So you've got fixed assets in the top one. You've got the next line down, which is your current assets. So that's going to include cash, the amount of money that the business has in the bank. It's going to include trade debtors, so the amount of money that the business is invoiced out but not yet received in. And it can also include a couple of other things, so like can be accrued income, so a job that you've done but not yet invoiced out. It could include stock, it could include prepayments, so like an insurance policy, you pay out for say £1,000 for the year, you pay that up front, but actually it relates to the next year, so you would maybe prepay that expense and release it to when it's relates to. You've then got your creditors. Now in here, predominantly you're going to have your corporation tax, probably a VAT balance, potentially PAYE and national insurance due on the basic salary. So there's a small amount of national insurance due on that. And you might have a director's loan account as well. If the director's loan amount is within creditors, then the business owes the director money. If the director's loan account is included within current assets, then the director owns the business money. So what you find is, well, I'll come to that in a moment actually. Then further down, so you've got the net current assets, so the current assets less the creditors. And you've got creditors due after more than 1 year. So you're seeing this a little bit more often now because a lot of businesses during COVID took bounce back loans, and they are repayable over a 12-month period or potentially 6 years or 10 years. So you're seeing the amount of money that is owed after more than 1 year is split out as a long-term creditor. So that's what the 38,436 figure is there. You've then got accruals and deferred income, which is separated out. So an accrual might be for accountancy fees for the year that the accountant hasn't yet prepared them and is therefore accrued the costs to be recognised. So that's really covers off the balance sheet. Roger, if there's any questions as I'm going through relating to what I'm going through, then feel free to dive in.
Craig, Mark, can you hear me?
We can now, yes, Rog. Yeah.
I had some technical issues. There's been a number of questions just coming in, Craig, from the guys, and I'm just trying to pick. So you've come back to a couple. Lauren had asked one just to confirm for affordability, where a lender will use salary and net profits from a limited company. She said we'd use the 121,724 figure for affordability. That was the question, Craig. Does that make sense?
Yeah, really good question. Mark, can you just scroll up to the page above this? The previous page. Yeah, perfect. Yeah, so where a lender will use company accounts. So this will happen where the person who owns the business is not drawing out all of the income as dividends. So what you might find is they might be earning a good profit. So for instance here, the net profit here is £121,724. They might then only draw out £37,500 worth of dividends because they don't want to incur higher rate tax on it. but there's healthy profits. The profits just get built up in reserves and are not drawn out of the company. So in that instance, you might want to say go for a mortgage for say £400,000, but if you've only got 12.5 grand salary and 37.5 grand dividends, 50 grand's worth of earnings, you're not going to get a mortgage on your own for £400,000. You're talking about multiples of 4.5, 5 times of income. Now, the way that this is used and the figure that you would use from this page is, you are absolutely right. The 121,724 is the net profit figure. However, included within the staff costs is also £12,500 worth of salary. So in my experience, on the account certificate, they will ask for how much salary is being paid. And so therefore they can use that salary plus the net profit. They might also ask for pension costs. So a lender will generally use pension costs, so salary, dividends or net profit, and pension costs for the director, because they can be altered and basically ceased. You can just stop putting money into a pension if the business needs to and the owner wants to draw more money out of the business to afford the mortgage. So those are the kind of three things that you would generally see being added together to work out what is available for affordability purposes.
Craig, we've got another really good question from Neil. It's one that you, me and Mark were discussing when we were preparing for this. Will full accounts always be available, Craig, from the accountant? Often clients swear they only have the abbreviated ones from Companies House.
Yeah, great question. So yes, a full set of accounts have to be prepared to be able to produce the abbreviated set. So the abbreviated set would only be the balance sheet. So Mark, if you can just scroll down one page, pretty much it's going to just show you that, and that's not enough information for a mortgage lender.
Yeah. But basically, that information is available because they couldn't have done their obligatory return to Companies House without actually preparing the full set in the first place.
Yeah, so I would say that they would always be available. So you would just basically, I mean, if I'm a mortgage broker and I get that response from a client, I'm going to be saying, give me your account's number so I can get what I need, and actually just, speak to them directly, get the full accounts, because you're going to need them for the mortgage. So yeah, that's what I would do.
And Philip S has asked, will staff costs include the director's salary?
Yes.
The next question is, would the reserves from previous years, Craig, be detailed separately?
Yes. So we will come to those. They are further down the document, so I'll pick that up shortly.
Perfect. Maybe we'll let you carry on and then we'll ask some more of these limited company questions that I think you might be capturing very shortly. Thank you. Thanks,
Sure,
Mark.
no problem. All right, so if you can just scroll down a little bit further, we've covered the balance sheet. There's a lot of information here that's not necessarily overly relevant for mortgage purposes. There is just this one section here, which is directors' benefits, advances and credits. So what you've got is here we've got a disclosure to say that John Smith has a director's loan account and he's been advanced £7,007 in the year. So at that moment in time, at 30th of June 2023, John owes the company £7,000. Now, generally, as you take money out of the company, generally you would declare a dividend to basically cover the amount that you're drawing out. So salary and dividends. But I generally try and advise clients to only live on £4,000 a month. £4,000 a month gives you 50 grand a year, give or take, with a little bit extra at the end of the year. To do that, you then kind of ensuring that you're not going to go into the higher tax threshold. So if you're generating a decent profit like this business is, and you draw out £70,000 worth of dividends, £20,000 worth of dividends, well, say £70,000 worth of total income, including the salary, £20,000 worth of dividends are going to be taxed at 33.75%. So your tax bill goes from like £3,000 if you're on 50 grand a year personal tax bill. If you increase that to £70,000, your tax bill is going to increase by about £6,000. So you're going to have a £10,000 tax bill personally, not 3,000. So there's a big jump. So I always try and make sure the clients are aware that they're only drawing out £4,000 a month, even if the business is generating more profit than that. You might have an instance where business is the client is doing something, maybe like buying a car before they sold their old one or something like that. It's just a short-term loan within the business. That has to be disclosed. So if they've drawn out more than their dividends, it has to be disclosed. It might be that they've repaid that shortly after the year end, and that would be absolutely fine. There's no tax consequences of that. If you haven't repaid it within 9 months of the year end, then you have to pay overdrawn director's loan account tax, and that's 33.75%. So they basically tax you as if you've drawn your dividends out. So yeah, that's just a refundable tax. So when you repay the money back into the company, you end up with the tax charge being refunded, which is nice, but there is a time limit. You want to do that within 4 years of the end of the accounts. But it is just a red flag. So when it comes to mortgage purposes, it's a bit of a red flag that the director has taken out more money than they've declared in salary and dividends. So you'd maybe want to ask more questions around that. Has that been repaid after the year end? So definitely look out for that kind of area in the accounts. Okay. So if we can just scroll down to the next page, that's just finishing off the balance sheet, and that's where the director signs it. So if we can just scroll to the next page. Okay, so these are the notes to the accounts. And again, this is not really relevant for mortgage purposes, so I'll try and cover these fairly quickly. You've got a fixed asset disclosure there, so you've got some tangible fixed assets and some investments. You've got more detailed versions there, so it's plant and machinery. It might say motor vehicles. It'll show you what the original cost was, £2,819. And then any additions in the year, so any new purchases of assets, 833. And then the depreciation charge, so how much depreciation has been charged in previous years, what's the current charge for the year, and then what's the net book value. So yeah, you can scroll down the next bit. Thank you, Mark. So so investments are really rare, so you're not really going to see many with these. But this is where a company can invest their own funds. If they've got surplus funds, they could invest on the stock exchange. They could invest, a couple of other areas really. But it's going to be really rare that you're going to see these disclosures. So we'll just scroll down to the next one. Okay, you've got a breakdown of current assets here. So this shows you that from the balance sheet, the £61,802 figure on the balance sheet is broken down between cash at bank, trade debtors, and then loans to directors, 7,000. So that again is a bit of a red flag to say that there's a potential issue here. Mortgage lender would pick that up. There's been money loaned here to the director. What's going to happen with that? Is it being repaid? Is it cleared by dividends? What's the story? So that's definitely something people would ask about and something to be wary of. Because if you can pick that up early, you can address it when you put the application in, rather than it being something that gets picked up by the bank, which is a bit more difficult to deal with. It's certainly not something that I would, in my experience, think that you fail to be able to achieve a mortgage. So yeah, the next section here is analysis of the trade creditors. So trade creditors is generally like if you've went and bought something but haven't yet paid for it, you've got an invoice that's not yet paid, corporation tax, that would include any overdrawn direct loan account tax as well. Other taxes and social security is going to be your VAT and any pay-as-you-earn national insurance owed on salaries. And then loans from director there is nil in the current year and £13,000 in credit in the previous year. So yeah, that's not a problem at all. The business is not going to be an issue for mortgage purposes. If the director has loaned money to the business, it's not a financial risk at all. It's an asset for the director. You've got bank loans and overdrafts there, and then accruals. And then if we scroll down just a little bit more, Mark, perfect. So the table right at the bottom of the page there, somebody did ask, where would you see about reserves brought forward, right? So this is where it shows You've got your share capital, £100. That generally doesn't change unless you've issued more shares, got some new investors. So generally that would just be the same. And then you got your profit and loss account. So the figure, the 4512 figure, is your brought forward. So the reserves that have been brought forward, profit that's been generated, had tax paid on it in the company, but before any, well, that's net of any dividends that have been taken in previous years. You've then got your profit for the period, 97,000. And then you've got your dividends there showing 101,000. And that brings you back down to the reserves that are carried forward. So in this particular year, they've declared more dividends than they've generated in profit, but not substantially more. So, that's fine. That's really sustainable. I don't see that as being an issue to be flagged by the mortgage company. But yeah, you can pay out dividends that are brought forward from reserves in previous years. So that's where you would see that. Okay, so I'll just deal with this question, Roger. That's all right. So
there's a couple of questions I'd just like to run through. Which, let me just work from the bottom. One, Tim had said, would a director's loan be taken off for affordability, Craig?
Yeah, I mean that's a question for the lender. Yeah, directors' loans have become a lot more frequent when you had the bounce back loans during COVID. So basically, a lot of businesses have been impacted. The normal income has been interrupted. A lot of uncertainty. People took bounce back loans and then used that to pay their own kind of salary and loan it against it as well. You couldn't pay a dividend out of the bounce back loan because it's not profit. So I don't know how a lender would view that exactly. Probably have their own criteria, lender by lender. I'm not sure.
Matt, do you want to answer that? I'll happily answer it. Do you want to answer it?
You can answer it, Rog.
So when it comes to the bounce back loan, so where a loan has been taken from the government or another source, and that was being used in the overall affordability, we wouldn't be able to use that at Tandem, Craig, because it's not actually their income. So for us, it would be a no. But Hassan, on the opposite side, has said, what if the client gave the company, for example, a £250,000 injection for it to start? How would that show on the document, and how can a client take this money back? Now, I assume that's different to income because, in effect, it was a loan. And you can't, I can set my business, put £1 million in and take a salary every year of 200 grand. And that's not really the business's income, is it, Craig? So do you want to just explain that for the crowd? Thank you.
Yeah, sure. So an investment is generally made in one or two ways. So you either loan the company the money, and that would be shown a little bit further up, Mark, if you can just scroll back up in the creditor section. Perfect. So here, so in the 2022 year, on the right-hand side, you've got loans from directors. Within the creditors section, there's a £13,000 figure. So if they'd loaned 250 grand, that would be showing there, net of any repayments, add any interest that he might charge, and then so that would show there, and any repayments that you make would reduce that balance. It's not shown as a dividend, it's not shown as profit, so it would only be shown in that creditors. The other side of that would be that the money would be in the bank account unless it's being spent on expenses, which would create a loss. So that's one way. So if it's a loan, that's how it would be shown. Mark, if you can just scroll back down a little bit. Yeah, perfect. You could also end up injecting that money as share capital. So there's a couple of reasons why you would do that. One is if you're going to, if there's multiple investors, potentially you can get EIS tax relief, SEIS tax relief. So there's a little bit of income tax you can reclaim if you're putting some money in to start up a new company to incentivize investment. There's lots of criteria, lots of businesses that are excluded, but you might have share capital. So the share capital figure is always, if it's a £1 ordinary share and you've got 100 shares, the share capital will always be £100. So you could have a 10p share or 20 quid share or whatever, and then the number of shares would always then show you the total nominal value of share capital. If someone's put a large amount of money in, that can often be shown as share premium. So you paid more than the £1 share that it's been issued at, the par value, and that can be shown as share premium. So you would have another column here called share premium, and it would be shown there. And yeah, that's kind of how it's shown. If it's a capital investment, if you're putting it in as an investment against the shares, yeah.
Thanks, Craig. Gary B said, could you just, he apologised, he said, can you just clarify which figure would be classed as gross profit? Just to sort of save any confusion on that one, please.
Yeah, sure. So these set of accounts don't actually show a specific figure for gross profit. Mark, if you could just scroll down a little bit, so to the next page along. Yeah, perfect. So this is what's known as a detailed profit and loss account. So in here, you've got your total income at the top, 209,000, and then you've got some other operating income, 1,500. You've then got your cost of raw materials and consumables, so purchases, commission, subcontractor costs. And then generally, that would be your direct costs. So you might have a figure there showing gross profit, but that's before you've deducted all of the other business expenses. So things like salary, wages, your depreciation, your office costs, your utilities, any other general expenses, sales, marketing, advertising costs, all of those have to come off, and then you get to your net profit. So gross profit is the difference between like your direct costs. So it's only really used not so much when you've got like a service-based business, but if you've got a goods-based business, so if you're a retailer and you're buying in stock, so you might buy in, I've got like a kids toy shop as one of my clients, and they might buy something in at like 20p in bulk, and then they'll sell it for £1. The 20p pound would be shown as revenue, and then 80 pence would be shown as gross profit. So that's kind of basically what gross profit is, and then the net profit is what's left in the business after all of the expenses. So I hope that helps.
Yeah, thank you. And Lauren N says, what's the situation, Craig, with micro accounts? Lauren's had a client previously who said that they only produce micro accounts. What's your answer to that one, Craig?
Yeah, so micro accounts are basically like the abbreviated set, the filleted set. So where you only really see the balance sheet, and it's really basic information. No analysis, no detail, no profit and loss account. But again, the micro relates to the accounting standards that they're produced. So they only have to submit really basic information to Companies House that are filed online and available for each company. But you can still have a micro full set of accounts, which are generally produced and a director would sign off. Which would then be used by the mortgage lender. So micro, and then it goes small, and then medium, and then large is the categories, and that's based on the size of the company. So a lot of really small businesses are classed as micro. The limits, if I just remind myself, yeah, I mean, there's really small. It's a really small limit to be classed as a micro entity. So less than 632,000 turnover, less than £316,000 on its balance sheet, and less than 10 employees. And it's got to have two out of three of those. So you can have turnover higher, but the other two lower, and that would be absolutely fine. You still would be classed as micro entity. So that's the kind of thing. So almost all companies that you're dealing with. The vast majority of SMEs in the UK are going to be classed as micro entity, and it's a relatively new term that's just kind of been brought out by new Companies Act legislation. So yeah, that's what it relates to.
And Mark, I've got a question for you. Andrea's asked, if a lender will accept most recent year's figures, will the lender still question a large increase from the previous year, as the second years are showing on the accounts? Obviously, with an SA3 or 2, you just get this year. With a set of accounts, it all shows the previous. So just what's a generalistic view and maybe an example of what Tandem might do?
Yeah, no, certainly. So if you do have a large jump in income, then it really is lender to lender, so you'd have to speak to this people. I'm not trying to get out of the question there, but it genuinely it is that way. If we were at Tandem, we were looking at a large jump, then we would probably want to be happy as we knew why that jump had happened. And more importantly, if that level of income was going to continue at that level. So that's what it's all about. So if a lender does ask the question, then that's what they want to be aware of. Is this level of income that they are now using for affordability going to be sustainable? Is it going to continue throughout the duration of the loan? And that's what we're looking to try and achieve with this. You might well get situations, particularly with net profit, where you can, if it's like a sort of a retained profit situation, where profit can be accrued over a number of years and can't draw out in the 1 year that we want to prove, for mortgage purposes. So we want to make sure that we understand the reason for the jump, and whether that income level is going to be sustainable going forward, because we need it to be. So generally across lenders, I would imagine they would follow suit with that, because they'll want to know that it's sustainable going forward. But you would probably need to speak to each individual lender to get an exact answer on what they'd want. Okay,
that's good. I'll let us carry on, because I know we are getting close to the time, and I'll let you carry on with it. We won't have more interruptions. Not sure. Interruptions, questions, because we haven't got that long.
Thank you. Right. Yeah. So this is the detailed profit and loss account. It details where all of the expenses in the business have been spent. And if you just scroll down right to the bottom of the page, Mark, please.
Okay.
And just a little bit further. So you can see all the different categories. And then you've got, so right at the bottom, you've got your total profit before tax for the period, 121,000 that we saw on the other screen. That's the net profit before tax. And then you've got your corporation tax charge there, 23,842. And then that goes back up to the other sections that we've seen, the summary profit and loss account, and then the reserves figure as well. So that's a full set of accounts, fully analysed, that really honing in on the things that are relevant for mortgage people.
Perfect.
Yeah.
Thank you so much.
Want to switch maybe back to the presentation, or if we just want to use 5 minutes to answer questions, whichever you want to do.
Okay. I've been through these bits here, Craig, haven't we? I think.
Yeah, we have on the full set. Yeah, I think it's useful to show them. So if we are sharing the slides, I've annotated things there. What it shows profit before tax. That's what it'll show in the full set of accounts. But net profit is what the lender will ask for. So it just kind of flags which figure it is that needs to be shown on the account certificate. So yeah.
And this one, we've covered a few of them throughout, haven't we? Really?
Yeah.
Is there anything on this list here of sort of common issues that you come up against?
Yeah, I can cover these. So just to recap on a few common issues that I find. So the tax year, the personal tax year, is always 5th of April every year. So that can be different from the company tax year. So the company is generally set up any time during the year, and the company year end will be the end of the month that it was incorporated in plus 12 months. So if I start a company now, 26th of September 2023, the first year end is going to be 30th of September 2024. So when you're looking at your accounting certificate, which is asking for salary and dividends, that can differ from an SA 302, because it's asking, the SA 302 is based on the personal tax year of 5th of April every year. So I've had a couple of questions around that. So why has the income changed? Generally, if a business is trading fairly stably and the dividends drawn are regular dividends, then you're probably not going to have a big discrepancy. But if you've had a cease of trading, or like a pause, or the business has undergone some changes, then you potentially will have a discrepancy. So that's definitely something to flag that. Have a look at the company accounts, have a look at the account certificate and the personal tax computation, SA 302, do they all kind of marry up and match with what the client's told you? So that's one thing. Director's loan account, we have already covered. Bounce back loans, we've covered. Long and short accounting periods. So you can have a normal accounting period. I would say 95% of limited company accounts are done and produced for 12 months. So you'll have, like we had in the example, set of accounts 30th of June, and then the next year will be 30th of June and the year after that. But you can lengthen and shorten accounting periods. And you might do that for tax reasons. So if you've got a loss in one period, you might want to just shorten it, cut that off, claim the loss, carry it back against tax you've already paid. Or if you've got large profits, you might want to shorten the accounting period. If there's been a spike in profits, you might want to shorten the accounting period to before the 1st of April 2023, before the tax rate increased. Because if you have a period that straddles that, you can end up paying more tax at 26.5% than you would necessarily need to. So that's another reason why you would see that, particularly in this period where there's been a tax change. So with a bit of foresight and planning, you can potentially reduce the overall tax rate. SA 302, tax unpaid does not tie into tax year overview. We covered the common instances there. So your student loans, your record not matching with HMRC, employment income, or there's often national insurance issues as well. So if someone hasn't registered correctly on the national insurance database, sometimes I can produce a tax year overview, an SA 302 that has the correct amount of national insurance charged, and then HMRC will come along and remove it completely in its entirety. So that's for class 2 national insurance. That's a common issue. So then I have to write to HMRC, get them to correct it. That takes like 3 months and slows the whole mortgage process down. And then switching from PAYE to self-employed and limited company. So a lot of the time I've got a big bank of contractors, and they'll often change depending on the job. So they'll just go, maybe work on an offshore rig, or basically just go and follow the money. People just follow the money, and might do a 6-week stint at one power station, and then that might be PAYE, and then they'll switch to limited company. So that then becomes a real challenge for a mortgage broker to try and actually identify what are their earnings, unless they've caught them in a period where they're actually just employed for 3 months. That's nice and easy, and you just send the pay slips off. But so that might warrant a little bit more work, a little bit more information from the accountant to say that the earnings are relatively stable. It just comes in different forms, and maybe to write a note on the account certificate for that. So yeah, I think that kind of covers all the common issues. If anybody has any questions that have gone unanswered so far.
I'd carry on to the end and summarise, because we only really had the 1.5 hour allocated, Craig, and there may be people who've got to go. So if we get to the end, and then we can just summarise.
No, we are pretty much there now. Yeah,
we're there. Rog.
Oh yeah. I mean, Craig, I just want to say that was just absolutely outstanding. Your details are now on the screen, and just to say to everyone who's joined, before you have to go, if you haven't had a chance yet to register with Tandem and you want to find out more about what we're doing, then please do. Hopefully that has recorded right the way through. Adam did say, Matt, that it stopped recording, but I think we did manage to keep the recording going. So hopefully what then will happen is it takes about 10 days to get signed off by compliance and to be cut and topped and tailed and being on Tandem TV. So if you go to the Tandem for Intermediary website, the top right hand corner, it says Tandem TV. All our educational series will be found on there. We're unable to transcribe all the questions given for Craig with the transcribed answers. You literally just have to re-watch the presentation and fast forward it, moving on. But I just wanted to thank you, Craig, for just what was outstanding, constant information, which I know really is hard to do. And I apologise that we had to keep jumping in, but if you don't keep asking the questions at the appropriate time, you're then going to keep going back into the presentation to understand where we are. So from me, just outstanding, both of you. You did exceptionally well. Mark, anything from you?
No, just wonderful. Thank you so much to you, Craig. That was a fantastic, really, really detailed responses to all the questions and coverage of the accounts. Really enjoyed the series so far, and we look forward to the future. So thank you so much for joining.
And don't forget to join next week when we go a deep delve into the legal process, particularly why you need a solicitor on a standard remortgage. But again, thank you, Craig, and thank you, Mark.
Thank you for inviting me. Good to spend time with you both.
He feels like family at times, Mark. He really does. Thanks, guys. Have a wonderful day. And just remember, if you haven't registered with Tandem for intermediaries, now's your opportunity. Adam and Daksha will be waiting by the phones to help and guide you through that process. At least I got my microphone working again, Mark. That was know what happened there.
And I think we timed it to perfection, didn't we? And I just finished that 12 on the nose.
On the nose.
Craig, it was brilliant. Absolutely brilliant.
It really was, mate. That was brilliant. Really, really good.
Thank you.
You'll need to lie down now.
I've got work to do.
By the way, guys, as everyone is leaving, you are putting in the chat facility some really good comments. So much thank you. Hassan, I know I went over one of the times. Denise, Beryl has listened in. Beryl said outstanding again from Mark. Good support from Craig and Roger. Thanks, Beryl. I think she loves you too much. Henry, thanks for the very useful presentation. It's very hard to structure an accounts presentation, guys, to be able to allow it to be interactive and not just being presented to. And that's the way that we're trying to do this. But I've got a feeling also, just by the feedback, a lot of people, Craig, will ask you to come back and do a rerun. But let's see if we can come up with that money and we can secure you again. So we'll have to see in our marketing budget, Mark.
Thank you so much, Craig.
Bye-bye.
Bye.